What we're going to be going over here is manufacturing overhead costs and variances. But for this problem, we're going to be looking at just the variable overhead portion of our manufacturing overhead. And it's going to be based on a standard costing system with a flexible budget. And just say, for example, here you're managing a particular factory department here, and you have to determine what's going on with the variable overhead in this department. And let's say for a certain period here, like for a month here, we're going to be looking at the variable overhead in this department here. So what we're going to be doing here, I've got it laid out in T account form, and we're going to be tracking this variable overhead through our various T accounts here. And we're going to make our calculations here to determine what we would be assigning here for different variances for this overhead. So conceptually what's going on here is you're taking your variable overhead here, you're going to have some actual costs that you accumulated here for the month for your variable portion of the overhead here, and those actual costs are going to flow into a manufacturing overhead control account. I'm just showing it as a variable overhead account here, but it would actually be going into this manufacturing overhead control account, and then it would be flowing into work in process, again our control account here, and it would be flowing in at the standard cost. So what the problem is here is we're going to be given a standard cost here, or this is going to be a budgeted standard cost here established for this department for the month here, and this standard cost that we have here varies or is different from our actual costs here. So what we have to do is based on the difference here between our actual cost and our standard cost, we're going to have these variances here, and it's going to be broken up here in this way. We're going to have our variable overhead spending variance that we're going to be calculating, and then it's going to have the variable overhead efficiency variance. So these two variances here are going to account for the difference between our standard cost here, our budgeted standard cost, and our actual costs. Okay, so before we get into our calculations here, let's go down and look at our reference key. So for our problem here, and I've got it marked in red here, SVOR is our standard variable overhead rate here. SFOR would be the standard fixed overhead rate. We're not going to deal with it in this problem. And then AHU here is the actual hours used. SHA here, standard hours allowed. DH, those are the total budgeted direct labor hours here for this monthly period that we're looking at it. And they're referred to as the denominator hours because they're in the denominator of our equation here for determining our standard variable overhead rate. So what we're talking about here for the standard variable overhead rate, to calculate it, you just take your total variable overhead costs. Now those would be the budgeted amounts that you're looking at here, and you're going to be calculating it on a per hour rate. So this is all budgeted amounts here. So you take your total budgeted total variable overhead costs for the period here and divide it by the total direct labor budgeted hours that you have for the period here, and that's going to give you your standard variable overhead rate on an hourly basis. Say for example here our total variable overhead cost that we budgeted was $144,000 for the period that we're looking at, this monthly period for this department we're looking at, and the total direct labor hours that we budgeted was 4,800 hours here. So the division here is going to give you $30 per hour here as your variable overhead rate cost here, or $30 per hour here based on every direct labor hour that was spent. It would go against would be charged to the variable overhead cost. So if you look at it in these terms, you just take your $30 here per hour here for your variable overhead cost, divide it by, and let's just say our labor rate here we had established at a $15 standard rate here. So dividing your $15 labor rate into your $30 per hour variable cost, you're going to come up at a standard rate here of 200% here for your variable overhead costs. So thinking of that in this terms here, say for example you have $7 here in direct labor that was charged. You take 200% of that, or your variable overhead rate here is 200% of your direct labor dollars. So 200% of the $7 here in direct labor would equal $14 here in the variable overhead rate. So you see what's going on here when we often work with these percentages here based on direct labor dollars. So you have to determine your budgeted amounts here for both the total variable overhead cost and the direct labor hours that you plan for the month here, and then you can determine your total variable head rate here on a per hourly basis. And then if you know whatever direct labor dollars you have here, just take it times that hour or that percentage or that rate here for your direct labor, standard variable direct labor here, and that's going to give you your your variable overhead cost. So that's just how that works. Okay, so let's go up and let's look at our problem here. So we're going to start out with our actual costs that were accumulated here for the period for that variable overhead, and it was $121,500. So that's what we actually experienced here based on miscellaneous accounts that are coming into this variable overhead, miscellaneous accounts as our variable overhead. So now this is going to flow into actually a manufacturing overhead control account here, this actual cost, but I'm just showing it here as in the variable overhead, just for our understanding of our problem here, coming in at $121,500, but it's going to flow into our work in process here at the standard cost of $120,000. So how do we get our standard cost? We just take our standard variable overhead rate here times the standard hours allowed here. And in this case, our standard variable overhead rate here was $30 per hour, and our standard hours allowed for our department for this month here was 4,000 direct labor hours. So $30 here times 4,000 is going to give us our standard cost here of $120,000. Now we can make that comparison to our actual cost here, but we'll make one other calculations here to understand this efficiency variance here. So you take, in this case, we're going to have our standard variable overhead rate of $30 per hour times the actual hours used. And this is the case here where we actually used 4,100 hours. So $30 here times $4,100 or 4,100 hours here is going to give us $123,000 here. And that's really what we're doing. All we're going to be doing is comparing our actual hours used times the standard hours allowed here at that standard variable overhead rate, and that's going to determine our efficiency variance. So just the reason I made that calculation here. Okay, so now let's look at this $120,000 here in standard cost here versus our actual cost here, $121,500, and see how it's split up between our different variances here. So starting with our variable overhead spending variance. So this is where we take just our actual hours used, $121,500 here, and we would subtract from it our standard variable overhead rate here of $30 per hour times the actual hours used of 4,100 hours here, 4,100 hours. That total amount here would be $123,000. Now, what we want to do here for our variance, you can see our actual amount here was $121,500. So our actual amount is less than what our budgeted would be based on our actual hours here. That budgeted amount based on our actual hours here was $123,000. So we're under budget here, and the difference is $1,500 here. So we would credit or reduce our variable overhead spending variance here would be credited or reduced here as a favorable amount here of $1,500, simply because our actual hours used was under budget based on the budgeted based on a standard actual hour. Our actual amount here, excuse me, that we have in variable overhead for the period is less than our budgeted based on our actual hours used here of $123,000. Okay, so that takes care of our spending variance here. Under budget, favorable amount, it was credited or reduced here. Now moving over to our variable overhead efficiency variance. Now again, it's going to be based on budgeted based on the actual hours used here versus our standard hours allowed. So to determine that, you just take your actual hours used here, subtract from it the standard hours allowed, take it times your standard variable overhead rate, and that's going to give you your efficiency variance here. So actual hours used, 4,100 here, less the standard hours allowed here, 4,000, times $30 here, your standard variable overhead rate is going to give you 3,000. So that is, we're going to debit that account here for $3,000, and it's going to be an unfavorable amount. Anytime you debit something that's an unfavorable amount, you credit it, it's favorable. So looking at our debit here, and that's simply because we're essentially over budget here. We have used 4,100 hours here, and we were only allowed 4,000 hours. So we got 100 hours here extra that we had to account for, times the $30 standard variable overhead rate, $3,000. So that gives us our variable overhead efficiency variance, and it's unfavorable. So if you just want to look at your total variances here, we have the $3,000 unfavorable, a $1,500 to subtract from it the $1,500 favorable amount. So your total variance is $1,500 unfavorable. $3,000 unfavorable, compare it to the $1,500 favorable, gives you the $1,500 unfavorable. And if you go up and look at it in terms of our T accounts here, you can see our actual cost here. I'm showing it as a credit amount here, $121,500, and then our debit here would be to our standard cost here, $120,000, and the balance would go to, we have a debit here of $3,000, so we're up to what in our debit amounts here, up to $123,000, and then we have this credit here of $1,500. So that would reduce our debits here by in a way, we end up with the balance here of $121,500. Just looking at our T accounts when they flow through here. $121,500 as a credit, $1,500 here as a credit. That adds up to $123,000. And that balances with our debits here. $120,000 here in our standard cost, $3,000 here in our efficiency variance here. Total $123,000. Balances with our credits here of $123,000. But really what we're just looking at here when we're just comparing this actual cost, $121,500 to our debited amount here of $120,000. So we got a $1,500 variance that we have to account for. And it would be unfavorable because our actual costs here are $1,500 over what we were allowed here in our standard cost. And that is where we came up with our variances here. We had the spending variances, which was favorable or under budget here by $1,500, or under our standard allocated amount here by $1,500, versus our variable efficiency variance where it was over budget or unfavorable here by $3,000. So what you're doing here, just remember here, you're looking, when you're talking about the spending variances here, it's really just taking your actual cost and subtracting from it your budgeted based on your actual hours used, and whatever the difference between the two is. If your actual cost was actually more than your budgeted actual hours used here, then you would have had a debited amount here, and that would have been an unfavorable amount. In this case, it was just the opposite. And then for our variable overhead efficiency variance, again, it's just based on our budgeted based on the actual hours used here, times less your standard standard, what is this? The standard hours allowed here are based on our standard, and the difference times the standard variable overhead rate gives you your variable efficiency variance. So if our actual hours used here was less than the standard hours allowed, then we would have had a credit amount here, or as a would have been favorable here, would have been under budget. So you can just see what's going on here. We're just making those comparisons, and I've tracked it through here using that key that we worked at. So just go through these. It's very basic here, but you just have to sort of remember what's going on here and track them through these T accounts here. You can see what's going on with your debits and credits in your T accounts, but your calculations are based off that key that we made here down below here. Based looking at those equations, we're able to calculate what should really be going on in each of our different key accounts. So just remember here, overall, you're taking what's going on here in your accounting for this here. You're taking your actual cost that's coming out of accumulated in your miscellaneous variable overhead account. It's going into actually a manufacturing overhead control account at some actual cost. You made some calculations here just to look at the for the efficiency variance in this case, and let's say that efficiency variance, if we didn't understand that, that was $123,000 here that we calculated based on the actual hours used, the standard variable overhead rate. We compared that to the standard cost that we have, standard variable overhead rate times the standard hours allocated, and the difference here went into our variable overhead efficiency variance. Okay, so that's just how it's going on. But overall, you want to take your actual cost that you have for the period here, compare it to the standard costs that is being recorded here in your work in process account here. And the difference here has to go into if you have a variable overhead spending variance here or a variable overhead efficiency variance that we discussed. Okay, so that'll pretty much end it here. But then again, I did want to point out this thing here when we were talking about this standard rate here. We had that $30 here per hour. That was the standard variable overhead rate here that we established for the period here, divided by $15 here in direct labor hours as a standard rate, gave us that 200% here standard variable overhead cost based on your direct labor dollars. So just to make that point here, just to summarize with that point here. So that's really what you're looking at here when you're talking about your standard costing here, based on your labor rate here, based on, again, some standard hours that were established here for this particular department for the month. Okay, so that'll summarize our topic.